Hey there, everyone, and welcome to the 2024 Q2 Investment Committee meeting highlights. Today, we're going to be kind of going over some of the investment-related themes that we talked about in our quarterly investment committee meeting. So, just to kind of kick us off, we do want to give out a brief reminder that today we're just going to be talking about some themes that are impacting the investment markets. And this isn't necessarily meant to be construed as any advice or anything of that nature, just discussion about some of the relevant facts that we discussed in our most recent investment committee meeting. All of us as a staff meet once a quarter, and we kind of go over some of these investment related topics. While every quarter may bring some different topics. Generally, we discuss some of the relevant economic activity, which is something that was big in Q2 and kind of in the past, few years. We've been talking a lot about this, about that economic activity. We talked about some of the financial market performances. We take a look at our model allocations and our investment strategy and kind of question, do we still like where we're at? Do we need to make any changes? And then we kind of discuss some clients specific issues or some common questions or themes that we see coming up. So without any further ado, I'll hand it off to Chip and he'll kind of get into some of the nitty gritty that we talked about this quarter.
John, thank you. That's awesome. This is one of those things that it's kind of looking behind the curtain, right? I mean, I think it's what we have been going through this systematic process every quarter for a long time, but and we have this information that we use, but someone had the idea, what, we should share this a little bit. And I think that's a great idea, there's people who are really interested in what's going on in the markets, what's our viewpoint, how do we feel, what are we basing some of our investment decisions on, and that sort of thing. And I think that's really important for people to know. And so, this is just kind of a look behind the scenes of what goes on, discussions that we have internally at Beacon, and really go through that formal process of, what's going on in the markets, what are clients, what questions are coming in, what things do we see that pose, opportunities, what things do we see that pose possible threats, and then just kind of, make sure that everyone is kind of on the same page. And so I think that's this is a great exercise for us, and we're going to get into some of the specifics. So it's kind of a technical discussion for some. I know a lot of our clients, choose to delegate, and that's totally fine. Maybe this type of discussion is not for you, but I think we have a lot of people who are interested and just want to know, hey, what's going on? What are your thoughts? And that's the purpose of this presentation. So I want to talk a little bit about what's really driving market volatility, market performance right now. And really, to me, the biggest driver is actions of the Federal Reserve Board. Okay, and we know back in 2022, we had a lot of discussion about, interest rate hikes and that sort of thing, inflation. And that's still, we're still dealing with some of that. Interest rates now are still pretty high compared to how they have been in the past 15 years or so. The federal funds rate is holding steady right now. So the Fed met a couple of weeks ago, and here's basically the summary is, interest rates are expected, the Fed expects to keep the federal funds rate where it is for a little bit of time. The Fed is very focused, and if you listen to the transcripts or read the transcripts, they're very focused on this dual mandate of, low inflation and low unemployment. And really their inflation target is 2%. And right now, inflation is a little bit higher than that, about 3% or so, although it's come down from what we saw in 2022 and as a result of COVID and that sort of thing. It's still pretty high compared to where the Fed really wants it to be. And so the Fed has made the decision to keep interest rates at a level that it considers restrictive to the economy. Okay, so 5.5% federal funds rate means higher mortgages, higher borrowing cost, and that sort of thing for people who are borrowing money. And so the Fed expects that to continue. In fact, a lot of the economic numbers that are coming out are pretty positive. Unemployment is really low. It's sub 4%. So, really low unemployment rate. And, that is a signal to the Fed that keeping interest rates higher is okay. As long as unemployment is still low, we're going to keep interest rates high. That's kind of the Fed's take. Now, Powell did say that if we started to see some deterioration of economic conditions and things like that, that he wouldn't be hesitant to cut interest rates a little bit to more normal levels. But at least for now, he's going to keep interest rates the same. And I think that he made the point, hey, I'm really pleased with how things are going. We've managed to avert a recession, which many pundits kind of predicted, and that hasn't happened yet. So the Fed is going to take a very cautious approach when it comes to going back and cutting rates. So that's kind of a theme that we wanted to talk about as a team because at least for now, as we're meeting with clients and our clients are doing things like buying houses and other things like that require access to the credit markets, then those interest rates are going to be a little bit higher than what they were several years ago, and so it's just part of the discussion with clients. So we want to make sure that everyone understands kind of where the Fed is and what the expectation is there, and we'll hit on that in a second. I think this is one of the things that we always look at, leading economic indicators. Now, this is just a gauge. There's nothing in the world of economics that says, okay, if this indicator shows this number, that this is going to happen in the financial markets. It's not like that. It's not that simplistic. The economy is very complicated. There are many moving parts and variables there. But I do think it's interesting, and one of the things that we should do is be aware of where the economy is. And so we look at the leading economic indicator index. And so, and this is a chart of that. So you can kind of see here that whenever the leading economic indicator index declines below a certain level, a lot of times you'll see these shaded lines areas or indicate a recession. So in the past 3 recessions, you can see the leading economic indicator index declines below this 5% negative threshold, right? So which means that index is declining by 5% or more. You'll see a recession. And so if we look at what's happened here recently, you can see, this index has started to decline in anticipation, really, of the interest rate hikes that the Fed kind of communicated with us. But you'll also see that we're not seeing a recession as of yet, and this index has kind of moved upwards, started to move back upwards a little bit, and that's kind of a good sign. Now, this is, again, it's not a cure-all that, we're out of the woods and everything's smooth sailing ahead. Not at all. That's not what I'm saying. I'm just kind of saying, we're pointing out that, by and large, the economy is pretty strong. And a lot of the indicators that we follow are showing that strength. And that's one. Okay. So this is a very important chart here. And John, feel free to interject and discuss things and ask questions. I know we had a kind of elaborate discussion about a lot of these things.
I have a couple that have come to mind, but I'll let you get started on this, and I have a couple.
Okay. All right. Good deal. So what we can see here is this is a very interesting graph because this is a federal funds rate. And this is what's happened. 2022 was the year we raised interest rates, all the way to 5.5% basically. Now there's something called a implied rate forecast. And so, you can look, and there are places you can go online that will show you, hey, the bond market implies that interest rates are going to be at certain levels at certain times. And so you can see back in October of 23, the implication was that, hey, and you can see from the last chart, hey, the leading economic indicators were on the decline, right? And so, maybe the federal funds rate was going to be high for a little while, or 5.5% or so for a little while, but the Fed would eventually cut rates. And that's what it was showing here. So it shows that the Fed is expected to cut rates, and this looks like about 100 basis points or 1%, from like 5.5 to 4.5, right? But what happened in December is, inflation really cooled quite a bit. And so at that point, everyone was like, hey, wow, inflation's really declining at a rapid rate. And with that in mind, maybe the Fed will cut rates, faster and by a larger margin, by a greater magnitude. And so that's what happened. This line is the December. So this one is October. And I know this is hard to see, but bear with me. This is October. This is December. Now, since December, some numbers have come out. Inflation has, maintained at a level that's higher than what the Fed wants. Unemployment rates are really low, continue to be low, and employers are experiencing even now a hard time filling positions and that sort of thing. So, the market data recently kind of suggested, oh gosh, well, unemployment is low and inflation is pesky, as it's higher than what the Fed wants it to. So these implied federal funds rate, it's gone up. So it's gone back up, drifting towards this original forecast back in October. And what's happened with that is the yield curve, the bond yield curve has shifted. Okay, and when that happens, we talked about this a lot in 22. When interest rates rise, when the yield curve rises, bond prices tend to decline. Okay, there's an inverse relationship there. And so you can kind of see this is bond performance over the year-to-date period. Okay, this is through May 8th. So, you see, a general bond index, something like the, Barclays aggregate index, is down about 2% this year. How can that be with interest rates, at 4 or 5%? Well, it can happen when the yield curve shifts, and it's temporary. Eventually, you'll see positive returns on the bonds as they mature within those.
And I feel like that's a question we got a lot from clients, is that statement you just made. How is it that bond funds could be down with rates being so good?
Yeah, and that it happens. It happens from time to time, and and that's a complicated question with answers that extend beyond the capability of this little webinar. But it happens. It's temporary. Because especially we're looking at these are indexes, right? This is a Vanguard short-term bond index. This is Vanguard long-term bond index, and these are basically index funds, right? And so over time, especially in the top three, these are very highly rated bonds that are in these indexes, right? And they eventually mature and are they're not the bonds aren't delinquent, and they don't
Right.
these companies have bonds and they aren't going out of business or anything. It's just that it fluctuates a little bit, just like any other investment does. And so that's what's happened here. And really the 1-year performance, and one thing to point out, the longer term bonds are much more sensitive to interest rate changes.
Yep.
Both on the upside and the downside, right? So as interest rates rise, long-term bonds take a pretty big hit, right? If interest rates decline, that number, becomes positive in a hurry. And so, we're kind of dancing this dance of, okay, how long should we structure the bond portion of their portfolio, right? I mean,
Yeah.
you see very short-term investments having good yields, longer term investments are more moderate yields. But if interest rates decline, you would have wished that you owned,
Yeah.
longer term bonds. So, nevertheless, the performance with bonds has been shaky, just because of that dynamic of what's going to happen with interest rates.
Yeah.
And long term, all that stuff works out. But it can be a little bit frustrating for clients. And that's one thing we are
Yeah.
getting the feedback is a little bit frustrating for clients when you have a diversified portfolio of bonds and you see negative returns in a period where interest rates are relatively high. But that doesn't really matter. It's the fact that interest rates are fluctuating. And that's what matters. I think at some point we're going to be in a situation where, in fact, I think we're close to that right now, where the Fed says, you know, further interest rate hikes are off the table. In fact, I think the Fed made a statement. You can correct me if I'm wrong, John, but in this last meeting, I think he said we're much closer to a rate cut than a rate
Yeah.
hike.
Yes.
I think it's like,
Yes.
uh,
And that kind of brings me to one of the questions that kind of came up in my head that I think that our viewers and listeners will kind of maybe can get some out of. We mentioned a little bit earlier the Fed's commitment to returning to a 2% inflation rate. Does that mean we got to get to 2% before inflation or before we're going to start cutting rates? They're going to start
yeah.
considering that?
So that's a really good point, and it's one that the Fed really emphasized. And Powell said, "Hey, inflation does not have to be 2%. We don't have to see 2% readings. We just have to be going in the right direction." Because what happens really is once inflation starts really going down, you can also get in problems with deflation on the other side. So really, you have to be careful. You want to make sure that the Fed has said, "Hey, we're not going to wait until to see a 2%
Right.
inflation rate before we start cutting interest rates." So I think that, at least that's definitely a good sign and really a positive sign for bonds going forward, which it hasn't been that way in a long time. So, I think we're at a good point in bonds. And if you think about it, John, I mean, for a lot of our clients, we have fairly balanced portfolios.
Right.
Most of our
Mhm.
clients might have, 50 or 60% invested in stocks and, 40 or 50% invested in bonds, right? And
Yeah.
so whenever you have a 50% exposure to bonds, and the outlook for bonds are pretty good, that's great. That's helpful. I mean,
Yeah.
10 years ago, it was that portion of your portfolio was, the expected return might have been 1%, at that point in time because interest rates were so low. So at least now we're seeing, reasonable interest rates. And I think that's really going to be beneficial for our more conservative investors. So,
Yeah.
that's a point there.
And before we move off the topic of bonds, and interest rates in particular, has the Fed kind of alluded to a situation where we're going back to, 0%, 1% interest rates, or are we going to be in
Oh,
a
no.
more normalized,
Yeah, I think the
interest
Fed
rate?
has done the opposite of that. I think they've said, "Hey, those 0% interest rates are history. We
Hmm.
need to change our expectations. Change it when you're looking at mortgages, change it when you're looking at financing cars and other things.
Yeah.
You can't expect a 0% interest rate. It's not going to happen." So yeah, I just think we need to adjust our expectations a little bit. And honestly, John, I hope that it doesn't happen because
Yeah.
think about why that it would happen.
Yeah.
Why would a 0% interest rate environment happen? It means there's some serious economic distress,
Yeah.
right? Which we saw in the Great Recession. We also saw it again in COVID. And those periods of time, you have to really stimulate the economy. And I'm hopeful going forward that we can be in a more normal situation where we're not having, the Fed's not having to artificially inject money into the economy in order to keep it out of recession. And, so the Fed has kind of said the opposite of that. Hey, 0% is in the rearview mirror. Don't expect that anytime soon. And if you think about Fed policy, if it's at 0%, the amount of risk that's in the system is tremendous because if the Fed has nowhere else to go, right? You
Yeah.
can't. I mean, you can
That's a great
go, I
point.
guess you
Yeah.
could have negative interest rates. I mean,
Yeah.
we saw that a little bit in Europe, but it's not something that you want to deal with. And so I hope that interest rates are higher. And honestly, our clients, many of which are conservative, can really greatly benefit on the returns of their portfolio. So a great question on that. Um, all right, so I want to turn the page to equities a little bit because stocks have done pretty well. You know, it's funny because when bonds decline, it's going to take some time to recoup, money from bonds just because it takes some time for bonds to mature and things to recycle. But with stocks, they can bounce back pretty quick. And so, year to date, stocks are up. At least U.S. stocks are up 7% or so as of, May 8th. And then longer term performance, 5 years at plus is pretty reasonable returns, historical, higher than historical average returns there. The one thing I want to keep reminding people of is, it's important that you keep in mind that your portfolio is a diversified portfolio. If you're a Beacon client, it is, and that's a real advantage because we don't know which types of stocks are going to do well, right? Are we going to see, is the U.S.
Right.
or U.S. stocks going to do really well, or international or small cap? Well, it doesn't matter because we own some of all of that,
Right.
right? And over time, it's kind of smooths the ride of your portfolio, which is really what you want. You want an investment experience that doesn't shock you, and
Right.
so that's one reason to have a diversified approach. And so, but it is notable that there is some performance disparity, right? And this happens, it's all the time, right?
Yeah.
You just have to prepare for it and expect it. I remember back in the early 2000s, late 90s, early 2000s, if we were looking at the S&P 500 had done really well. But then after the tech boom and bust, international stocks did really well, much better than U.S. stocks. So you kind of have to keep in mind that, a diversified portfolio means accepting the good returns, but also recognizing that sometimes you're going to have investments that are going to underperform relative to the good performance of U.S. stocks for now. Who knows what will happen in the future? I think, but there is some performance disparity. So keep in mind that your portfolio is not the S&P 500, right? There's a lot of reasons to not have your portfolio invested fully in the S&P 500. And we've talked about that in our own meetings with our clients and why that is. But at least right now, the equity markets are doing pretty well, which makes sense. The economy's doing pretty well. We're at full employment right now. There's actually the thing that's holding the economy back probably is lack of additional workers. There's kind of a shortage. So, and that also spurs inflation and some other things. So, it's at least for now, the stock market is doing pretty well.
Yeah.
And hopefully it continues, right?
Yeah. Yeah. That would be great.
Who knows? I mean, you can expect a decline of 10% or more, usually every year. That's pretty common. You can
Yep.
expect a decline of 15% or more every couple of years. You can expect a decline of 20% or more every 3 to 5 years. So it's going to happen. You just need to have that expectation and take advantage of it, when it does happen. And
Yeah.
and that's what we're prepared to do. I think one of the other things, John, we've talked about in our uh, investment committee meeting was um, what happens in the future. And I thought it was really timely because Vanguard came out with they put out every year a 10-year annualized return expectations. And really, this is based on stock valuations, and they also do it for bonds too. But we're only looking at stocks right now. So it's looking at stock valuations. When I say valuation, I think that means, are stocks attractive or are they overpriced? Have they gone too far too fast? Have they moved up too far too fast? And so what Vanguard came out with is, they'll come out and look at every single asset class in equities. And you can kind of see small cap, real estate, international, growth, U.S. growth companies, U.S. equity companies, just a diversified equity exposure. And so, you can see here, and we highlighted the 50th percentile. So this is kind of like the mid, because this is the upper end of a normal range of return expectations. This is a lower end of return expectations, right? So if we get right in the middle over the next 10 years, you can kind of see what they expect different asset classes to return. And I won't harp too much on this because, again, this is just they're throwing stuff at the wall in a way. It's kind of a guess based on historical numbers and things, but it is a guess. But what they're saying is, hey, the most attractive area is international stocks. And so, you can kind of see, well, the mid range of their return expectations is about 8%. If it's higher than that, that's great, right? And so versus U.S. growth companies, like the things that have done the best so recently, the NASDAQ is an index that people follow that this would probably compare to. The Russell 1000 growth is another one, but so those types of companies, they're pretty low on those companies. They think that they're overpriced, and so to us, we're aware of these things. We don't base our investment decisions on this. I'm not going to go out and sell all of our, U.S. growth companies and buy all international. That doesn't make sense. But it's just being aware, hey, this can happen. We can have modest returns in certain areas. And it's just, to me, a reminder that we have to diversify portfolios, especially for people in our clients' demographics. And so I think that's super important. And, but, they're saying return expectations are fairly modest for the next 10 years or so. And so I'm also thinking in the back of my mind, when we're running return projections for retirement plans, right? What returns are we going to use going forward? Well, I think we need to be pretty cautious about for those people who need to achieve an 8%, 7% rate of return in order to meet their investment objectives. We need to caution people that, that may not be realistic, at least for the next, period of time. So I thought that was interesting. We spent a lot of time internally just talking about, these types of projections and how, they're not totally accurate at all. And so, but they're a guide and something to keep in mind. And I think, Vanguard puts this out, and I find it interesting to look at it each year.
Yeah, definitely. Especially given the fact that, historically that might have not been the case, that, where international is going to be, or, they're projecting it to do better than US stocks,
Yeah. And, to be honest with you, last year's and the year before, they projected international to do better than US. So they can be incorrect for a period of time, but, there's still 8 years left in the, their 10-year projections from 2 years ago, right? So I think it's just important to keep in mind that we don't really know what's going to happen, but we need to be prepared. The other thing that we talked about, and honestly, I want all of our staff to kind of be on the same page with each other, and when we're thinking about how we manage client funds. And so I know that we have other people in our office that are more responsible for planning and tax and other things, but everyone needs to know, kind of where we are. Clients ask questions, you need to know how to answer things. And so some of the things that are on our mind internally, I just want to kind of go through those. We have had one of our bond fund managers has retired. And so we're kind of taking a wait and see approach there to see what happens. We don't have many actively managed mutual funds. We use index funds a lot just because we're very tax efficient types of investors, and we're very cost sensitive there. But we do have an actively managed fund on the bond side. And one of those managers it was two of the managers have been replaced. but they've been replaced by people who have been there for a long time. So, but nevertheless, we're still, closely following that. We're taking a wait and see approach, but there's a chance that we eliminate a fund for that reason. We also have this discussion of should we for the past 10 years, we've been pretty short maturity on the bond segment of our portfolio. Last year, I guess it's been about a year, right, John? We went in
Yeah.
and lengthened it a little bit with the
Mhm.
idea that the Fed has raised rates, and I thought at the time, hey, they're pretty close or at the end of that rate hike cycle. And so the idea there is let's take advantage of these rates while we can before the Fed starts cutting
Mhm.
rates again. And so, but we still have quite a bit of our clients' money in shorter term, the bond allocation in shorter term bonds. Should we increase that again? And ultimately, we decided to kind of hold steady for now. But that's on our mind. Just know that. Also, we're continuing to monitor what the Fed says, what happens in some of the economic indicators. The Fed's looking at, housing starts and, initial jobless claims and all these things that it's probably not on very many people's radar, but we're following that because it is an indicator of what the Fed, what their next move is. And we're especially interested in that. We're also interested in stock valuations. This is something that if we've had a meeting with you in the last year or so, we've talked about it. There are certain segments of the stock market that we believe are very overpriced. And it's funny because it's like the top 5 or 6 stocks in the S&P 500 index. Okay, so if something, these stock valuations are very high, I wouldn't be surprised at all if we saw a little bit of a correction there. And you can expect that anytime, really. But I think whenever you have valuations at the point where they are now, it becomes increasingly likely that you see a pullback of sorts. And so we talked in our meeting about, you have that expectation, but also what are we going to do if that
Mhm.
happens? What are our actions going to be, if any? And we kind of talk about that and think through, how we might approach that. And the other thing is just rebalancing. So, we have a number of clients where we haven't really had to rebalance in a little while because,
Yeah.
either maybe they're taking distributions, maybe they're adding money to their accounts, and so we're kind of rebalancing just on normal distributions and deposits and things. But we also haven't needed to make those changes very much because stocks and bonds there hasn't been an enormous amount of um, return disparity between
Yeah.
those in the short term. But now I think we're getting to a point where, hey,
Mhm.
we might need to realign our portfolios with their target allocation. So just be aware of that. But that's on our radar. So, that's kind of what we talked about, along with some other things that, again, are beyond the scope of this webinar. But I think that gives you kind of a look behind the curtain
Yeah.
and behind the scenes is what goes on when we're not having meetings and things with clients. We're looking at all of this data, trying to interpret that for clients' benefit, trying to position portfolios in a way that's both opportunistic and reduces risk if we can. And that's what the purpose of this investment committee meeting is, and I find it incredibly helpful and beneficial. So, any questions that you think people might have because I left out some data we talked about, John?
No, Chip, I thought you did a great job giving people the, kind of a look behind the scenes. I know Chip always will make the comments his favorite day of the quarter, when we get into the investment committee meeting and we all get to kind of sit together. It's always nice when we can all meet, and talk about these things. And, we spend the quarter kind of trying to get the data and compiling this. I mean, this meeting is, it's kind of an always evolving type thing. I mean, we're constantly getting new data. We're constantly looking for things that we can discuss in this meeting. So, while it happens once a quarter, it's evolving every single day, and I'm glad we're able to do it, and I hope that our clients and prospects or anyone who's watching found this just useful and informative. And I guess we'll see you next quarter. What do you think, Chip?
I think so. I think it's a good thing to do. It's a good habit to get into. I think that we have, a certain percentage of our clients may be
Yeah,
interested in this stuff. And I won't honestly, they need to know that, hey, we're
yeah,
following your portfolio really closely. I mean, it's not just the investments and the withdrawals and all of that stuff. It's
hmm,
a bigger picture.
yeah,
And, because you need to have that perspective in order to navigate, some of the issues that may arise in the future. So just know that behind the scenes, a lot of that's going on, and we're always happy to entertain questions if you have some.
yeah,
Honestly, the questions are what one of the big things that we talk about. When
yeah,
clients have we very rarely do we have one client ask one question.
yep,
It's 10 clients ask the same question. And so we want to be the people to be we want to be able to communicate answers, and this is a part of that process.
yeah,
So I think it's been great. I think we'll keep this going and
for sure.
see what kind of feedback we get. So if you're listening to this and you liked it, let us know. If you're listening to it and don't like us, let John know. And
Well,
but seriously, we love feedback. If there's something we
yeah.
can add, if you want us to talk about something else,
And like you said earlier, if you want us to talk about something else, probably somebody else also wants to hear that,
that's
all
right.
those questions. And so, just like Chip, I think you kind of alluded to, if there are any questions, we're definitely open to any questions anybody might have. And we hope you've enjoyed this, and we'll see you next quarter.